You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from the usual, from Montecito, California. Although today, again, will be my last podcast from the location where I'm at. I am in the middle of what I would call musical rentals right now, waiting to kind of land at a final destination. Long story, but if you're coming to Dallas, I'll be happy to explain it to you. Again, by now I think we might be sold out, but you may want to check it out. Our upcoming event, it's a meetup in Dallas, Fort Worth, and that is coming up on October 1st and 2nd. I'll actually be there a little early. I think I'll be there on that Wednesday. But, the activities are typically starting on Friday evening with a cocktail party, and then Saturday the event and tour, and then another cocktail party, and lots of cocktails. But if you are there early, if you're getting there early, also let me know. Maybe we can catch up as well. Like I said, I think I'll get there Wednesday at some point, but, maybe hang out with some people on Thursday and, kind of just, have a little bit of a vacation while we're at it. Go to wealthformulaevents.com. Check it out if you have not done so yet. Again, I don't know. It's probably sold out by now, but I don't know. But check it out, and hopefully we'll get a chance to meet you in person. Now, the other thing I should remind you is, if you haven't had a chance to do so, if you want to participate more in our community, there's a couple different ways to do that. If you want to start looking into potentially, investing in things the way we do, we have a group, a Reg D group called the Wealth Formula Credit Investor Club. You can go to wealthformula.com and sign up for that. And also, if you're just interested in, an online community, people to talk to and all that stuff, we have Wealth Formula Network. And if you're interested in, so who's good for Wealth Formula Network? Wealth Formula Network's good for people who like to geek out on personal finance, but their friends and family and all that stuff, they don't want to listen to them. So it's kind of a nice community for you to have if you want to get granular in this stuff. And I could tell you, it's really, I learn something all the time. I mean, we had a meeting yesterday, and of course, Ian Kurth, who we've had on a few times, Dr. Ian, broke down some numbers on, 1031s versus, bonus depreciation and all that stuff. And boy, I came out feeling like, man, I really learned something from that group. So there's always something to learn. I mean, I'm certainly not a guy who thinks I know everything. Every time I think I know something, there are many, many more things to learn. If you're one of those types who likes to join and participate in those types of things, check it out. It starts out with a course, your roadmap to real wealth, and then you have access to our Facebook group, and then these live bi-weekly phone calls. They're not phone calls, they're Zoom video chats. I don't know what's the proper thing to call those, but they're on Zoom. You can see each other, you talk to each other. So go to wealthformularoadmap.com, check it out, and hopefully we'll have you on there. Now, as far as today's show, there's a saying, and I think it was Bill Gates. I don't know. I've heard it from so many people. I don't know who really said this first. And then there's permutations to it too. But the bottom line is, the idea is that people grossly overestimate what they can accomplish in a year and grossly underestimate what they can accomplish over 5 years. And think about that. It's actually pretty profound. And the fact that we can't accomplish much in that first year often makes us feel demoralized and makes us quit. I remember the first time I ever started podcasting some years ago, and, I did a few podcasts, and I noticed the only person who seemed to be listening was me, and me a couple more times to make sure that things were working, and I'd check my downloads and there would be like 5 downloads, right? That lasted a while, and I actually had quit. I did like 3 or 4 podcasts. I think if you look at the podcasts, if it goes back that far, I did like 3 or 4 podcasts, and then I quit for a year. Then I came back, and I was like, I'm just going to do this. But, it's hard to plant seeds like that and, play the long game all the time. But when I look at that statement about overestimating what people, can do in a year, ultimately quitting because they think they couldn't accomplish something and underestimating what they can accomplish over 5 years. I think to myself on my 48th birthday, which was actually yesterday, September 8th, I look back on the last 5 years and it's hard to argue the point. I mean, the quote is very, very accurate because 5 years ago, well, this podcast did not exist, at least certainly not the reincarnation of the podcast after I'd quit after the first year. And today, Wealth Formula Podcast gets, about 25 to 30,000 downloads per month. Not enormous, but it's pretty significant. And we have an investor club that is significant with over 2,000 accredited investors. And that accredited investor group, we have about $800 million in assets under management. And those numbers are staggering, and I'm in awe of what we've created together over this short period of time. But the bigger lesson here is that even though it may not seem like it, all the things that you're doing now they absolutely do make a difference over time. And if you don't like change, you're out of luck, because the thing is, change is inevitable in life. There is no doubt. Things are just going to change. You're not going to look the same. You're not going to act the same. You're not going to have the same job or whatever over a period of time. No matter what, eventually you'll do something else, whether that's retirement or things constantly change. Your kids grow up, so change is inevitable. And so if you don't like change, you're out of luck. And change, you can either fight it, right, which isn't going to get you far, or you can help guide it in the direction you want to go. The same can be said about investing. The type of investing we do in our community requires planting seeds. And we plant those seeds today, and then we wait patiently, in most cases for a few years, for something to happen. And it's hard, but just think about those people who sat on the sidelines over the past 5-6 years, thinking that, we've been listening to all of the pundits in the podcast ecosystem talking about how, the zombie apocalypse was coming. And in the meantime, Western Wealth Capital, for example, was delivering average annualized returns of over 30% to its investors. So it's funny because we've sort of come full circle on this notion about time is money. Time is money. People use that in the context of if they work harder, they can make more money or something like that. But in investing, time is money as well, because the variable that people often don't think about is the variable of time, right? Understand that investing in real estate requires some level of faith. You can't track your net worth daily on an app like you can with some other stuff. However, once you're in it for a few years, you start to see things come to fruition in a big way. And I gotta tell you, we have some very exciting stuff happening with some of our earlier investments that can really see things coming to fruition. And once you've been through this cycle a few times, it really gets exciting, and you really, you get some faith in the process. But again, the choices and investments you make today, they are not for, tomorrow or the next day. They're for 3 to 5 years from now, typically. And the longer you wait to start, the longer it's going to take for you to get the results that you want. So it's time to get off the sidelines. That's the moral of the story, okay? And so while you take action today, it's also important to contemplate your next move in the future so you don't sit around and just kind of hurry up and wait. So I take that's a big part of what I do. I'm constantly thinking about my next move while I currently, do what I need to do now. And in my case, one of the things I've been interested in is the hotel industry, these Holiday Inns, that kind of stuff, I've been interested in that for a while, and I've kind of been monitoring that, collecting data, and looking for the most opportune time to potentially get involved. On this week's Wealth Formula podcast, I reconnect with hotel broker Steve Usher, who, I basically wanted to interview in part because I wanted to get an update myself on the hotel investing landscape. So when we come back from these messages, listen to my conversation with Steve Usher. Welcome back to the show, everyone. Today, my guest in Wealth Formula podcast is Steve Usher. Steve was on not too long ago. It was during the pandemic. He's a founder of a Pasadena-based Titan Hospitality, which is founded in 1999, which focuses on hotel brokerage assignments located throughout California. Since its founding, Titan has closed upwards of, $2 billion? That's a lot of zeros, so I couldn't tell for sure, but I think it's $2 billion. You can correct me if I'm wrong, Steve. And prior to founding Titan, Steve worked with Cushman and Wakefield in CBRE in San Francisco, so he certainly knows real estate. Steve, welcome back to Wealth Formula Podcast.
Hi, good to see you, Buck.
So, I keep wanting to talk to you because of my own sort of interest in potentially getting into the hotel space. We talked, sort of right during the worst of the pandemic. And at that time, I think you were honest in saying basically there's nothing going on. There really is no opportunity right now, and no one's going to finance anything. Has anything changed?
I don't remember what month it was, but, it's probably last summer, I think, when we spoke.
Yeah.
And, a lot's changed. I think that, in the cycle of the pandemic, the average hotel in California was probably down maybe 40% in their revenue, which was huge. Some markets more than others. Obviously, San Francisco was hard hit. Markets like Anaheim that relied on, Disneyland or any sort of convention business was even harder hit. And then when the vaccines came out, things bounced back, fairly nicely. There was a really nice trajectory there. I would say, maybe half of that had been recouped. And then obviously Delta variant came out and everything kind of slowed down again. So we're kind of in this muddle where owners are kind of making the best of what they can. They had PPP loans and things to get them through the hardest times. So there really wasn't a lot of distress. There really weren't any foreclosures. Lenders went, fairly easy because if you're going to call one loan, every loan in the bunch was bad. So what are you going to do? It's kind of like the financial crisis, from 10 years ago. So it's just kind of a wait and see right now. Not a lot of deals happening. A few markets did, fairly well. Drive-to markets, coastal markets, things like that. But for the most part, it's just been, fairly slow, last 12 months as far as deals.
Yeah. And along that lines, I think I remember you talking about how you felt like, well, there was, despite any drops, in income and that kind of thing that was happening, that really the people who were looking to sell were really not looking to discount. They're really not acting in any sort of distress. The deals that are out there, are they behaving the way you would think they would behave based on decreasing amounts of occupancy? Or are they, again, is everybody just saying, I got my PPP, I'm going to just stick through and wait until I can get what I want?
Yeah, the deals that are out there, the owners want pre-pandemic pricing. And for 95% of the markets, that's just not possible. So everyone's just kind of waiting around. Like I said, the numbers were down maybe 40%. And so in terms of profitability, that's all the profit. If you lose 40% of your revenue, you have an unprofitable hotel. And it was a little bit of a bounce back, but, it's very hard to get anything done because nobody wants to discount it. It's hard to force people to sell.
Yeah.
It's always hard. People always think all these deals are going to fall from the trees, and it doesn't happen. Even in the financial crisis that went on for, 4 years, very little happened. And a lot of it's creditor driven if the lender's not pushing it. And that's the case again now. It's hard to really force people to do something, force sellers to do something.
Well, that's an interesting point. I didn't know. So obviously in multifamily, in residential apartment buildings, such, there was a crunch, right? There was a crunch, and hotels in the financial crisis, were they more isolated than like apartment buildings, or more protected? I guess.
Well, I think what happened, as I recall, the bottom line was, in order for these banks to take it back, the banks were failing, and then the FDIC would have had to bail them out, and the FDIC ran out of money. So you had all sorts of games being played with splitting loans into A pieces, B pieces, C pieces, as many pieces as you need. So you could say, well, some portion of that loan's performing. It's only some little part of it over here that's not performing. You see what I mean?
Yeah.
So they really didn't want to foreclose and have the FDIC have to step up.
Yeah. That makes sense.
So after 4 years, not much happened. I mean, there really weren't a lot of distressed sales. And so with COVID, which was really, something that came out of left field, it hit us hard. And then we expected to bounce back from it pretty quick. And we, to some extent did, and now probably will over the next 12 months as Delta recedes. It's even harder to get, true distressed deals done.
Yeah. And then the PPP obviously added another level of sort of, of cushion. So anything that would have been real distress was not so distressed anymore. There's some guys I know who made more money during the pandemic.
Exactly. And now that's forgiven too. I think it's pretty easy to have the PPP forgiven.
Yeah.
Lenders just added, the loan balance onto the back of the loan. Even franchisors were, going easy. So everyone kind of allowed, everyone was pretty flexible, which is good. I mean, it's good for the market. It's good for owners, but it's bad for true distress sales.
Right. And it's not really letting the market sort of do what it potentially should be doing in a capitalist market. So, but I want to take a step back a little bit, Steve, because I know, probably a number of people who listen to the earlier podcast, but there's a lot of new listeners all the time. We are, in my group, for the most part, we are a, residential multifamily investor group. So we know a lot about that stuff. In hotels, how do you break down sort of the different kinds of hotels that are out there that an individual or a group can invest in?
You have obviously at the high end, the large full service properties, luxury properties, from a Ritz-Carlton all the way down to a full service Holiday Inn. So you have full service, and then you have select service / limited service. And, select service would be anything below full service. It's basically a rooms only operation, Hyatt Place, Hampton Inn, Marriott Courtyard, all the way down to really economy stuff like Motel 6. And, really where I would suggest investing is in that select service, because you really want to sell rooms. That's where you make your money. And everything else, especially in doing business in California, the more employees you have, really the worse off you are. So you want to limit your employee count.
Yeah.
So select service is really probably where to go. And the margins with some of the new type of select service that are more kind of extended stay oriented, I mean, you can do some really, really great margins. Yeah. You can have almost like, an apartment building, I don't know what your margin is, maybe a 65% profit margin before debt. With a good performing select service, you could be 45 to 50%, which is historically incredibly high for a hotel.
Yeah, that is very high. So when we talk about cap rates, what does that come out to in a cap rate?
Oh God. Cap rates are low because debt's so cheap now. So You're probably looking at 6 to 7%, maybe you can borrow, in the mid 4s.
Does that rely on, whether it's a boutique or, whether it's a full service, select service, that kind of thing too? Or is that generally not, is there not really a difference?
It doesn't really matter. The hotel nets what it nets. And then you derive a value from that, and then the lender will loan on that.
Well, not so much on the lender side, but I guess my question would be, for cap rates, are they, obviously when we talk about multifamily, we've got, you get cap, in California, if you want an A class, it's, a ridiculous cap, right? You're not going to cash flow. You're never going to cash flow. Whereas, if we go to Phoenix or if we go to Dallas Fort Worth, we'll have a little bit of cash flow and we can leverage that and make more cash flow. But if we're in the working class space, and so we can get a little bit more cash flow. But if we wanted to go to the A class, we're not going to really cash flow. Is it exactly the same type of thing in hotels?
A lot of it's driven by the barrier to entry of the market. If it's a market where they can build quite easily, then the cap rate's going to be higher. But then you always have the issue, someone's going to build 2 or 3 new deals, and you're going to have a tough time. So, yeah, you might see cap rates of as high as 8 or 9%, but I'd really question that kind of deal in California. Why would a seller have to settle for an 8 or 9 cap in this state? it's probably something that needs a lot of CapEx or is in a market where you're going to have a couple things built and it's really going to hurt you.
Sure.
So I think for a well-located deal, maybe a 7 cap is the number.
Yeah.
But even that's hard to find. It's just, it's always hard to shake loose deals in California.
Yeah. Yeah. Do you have experience outside of California as well?
Not really. Yeah. Everything I do is, such a big market that I just I stay in the state.
Absolutely. Talk about, if you would, how does it work with, say you own a place and it's a select service. Most of them are under the guise of some sort of franchise, right? I mean, is that pretty much what you're looking at, whether it's a Holiday Inn or whatever, is that's pretty much what you're going to do, isn't it?
Yeah. I mean, I would say, I don't know what the rule is, but I would say 80% of the inventory is franchised in some way. And now you're seeing some of the brands, because the customers like to get more kind of boutique-ish stuff. They don't want to be in a cookie cutter room. So you have, like, Marriott will have their autograph collection. It's still a Marriott, but it's the Marriott's going to be a smaller component to it. But it's still a branded hotel, and the franchise fees are going to be a little bit reduced, but the customer is going to see more of a boutique independent type property, even though they probably booked it through their Marriott, system.
Is it possible? I mean, not possible is a bad word, because of course anything's possible, but do you see a lot of barriers to success for independent owners who are not franchising? I mean, what's everybody's franchising? Why is that? I mean, probably is obvious to you, but it's not so obvious for somebody from the outside here.
Yeah, I mean, a lot of times it will be for the financing. A lender will require a brand. Okay. The loyalty programs, through the brands are very popular. So if you have a Marriott name or a Hilton name, you're going to, drive a higher rate, a higher occupancy. But there are a lot of givebacks on that. I mean, you've got franchise fees are enormous. The renovation costs requirements are high. If you go to sell, they really kill you on what they call a PIP, the product improvement plan, where they require the next owner to do all these upgrades.
Right.
So I think the industry is slowly getting away from the brands. The brands are getting less and less relevant, but right now they're still dominant. A lot of stuff comes through the TripAdvisors, the Expedias, the Hotels.com. That's where that's where a lot of the business is now booked. It's not coming in through the brand reservation systems.
Right.
So now the brands own Expedia and Hotels.com are owned by the same brand. So they, one way or the other, they're gonna get you.
Yeah.
And the other thing to point when you look at it, if you sell a room through Expedia, you pay Expedia their 20% or whatever their commission is. You then also pay a franchise fee, because your franchise fee to Marriott or whatever is based on a percentage of the room revenue. So you pay it several different ways. So to the extent you can get away from the brand, that's ideal.
There's so many fees, it's hard to imagine making a profit in this industry. But obviously you can. People are. How does property management work? Is that usually part and parcel with the franchise, or is that going to be yet another fee? That's
a totally separate deal. I mean, very few hotels are run, like let's say you have a Marriott hotel or a Hilton hotel franchise. Very few are going to be managed by the Marriott or Hilton companies. You'll either self-manage or you'll hire a third-party management company to run it.
So in many ways, it seems like the ideal situation might be for somebody thinks that they can do a pretty good job marketing for themselves to, have, a good property management company, but do the marketing and save on franchise fees, right?
Yeah, or the flip side of that is you have a good franchise, and because it's such a cookie cutter operation, they're going to tell you exactly what to do. You really don't have to think.
Yeah.
So then you just have a good general manager, and you don't really need so much a sales and marketing person, because so much is coming in through the brand.
Yeah, and that's a good point too, because I mean, in terms of marketing, it's not like that's for free if you're running on your own, right? You're going to be paying for that as well. So,
right.
Interesting. So in terms of like success. I mean, obviously, there's probably statistics on this, but, when you work with buyers, are you typically working with buyers who have a lot of experience with the hotels? Do you work with people who've not bought them before? Or, how has it been in your experience? Is it usually industry people?
I'd say it's 50-50. I mean, some have a lot of experience. Some are coming into it because they can get a slightly higher yield than they could on a retail center or maybe an apartment building or what have you. Or they're just, I do a lot of deals with, say, Korean buyers or Indian buyers, and they just want to kind of run their own business, and some, it's rare that I get someone that has had no experience. They've usually had something, maybe a lower end deal and they're trading up to something nicer. Hotels are a different animal.
Yeah.
It's not really real estate, it's a business. So generally speaking, the buyer has some experience, or they think they have some experience, or they think they're knowledgeable.
Or at least maybe in business.
I don't know.
That's
where a lot of the opportunities are, because you can buy a deal from somebody who isn't really doing very good revenue, management. And you can take the same property and do better. Maybe they're putting too many rooms online and selling them at a discount.
Do you find yourself in that being sometimes a little bit of an advisor to your buyers? I know certainly, our mutual friend who introduced me felt like you kind of taught him the business.
Yeah. So. Yeah. In his case, he was a true first-time buyer. So that was unusual, and he was going after a kind of a very high-end boutique. So that was very bold, to go from never having done a deal to saying, well, I'm going to have the highest rated hotel in the Coachella Valley, and he did it. But not many people can pull that off.
Yeah, absolutely.
That was a unique personality. But advisor, definitely. I mean, more so about what markets to go into, what markets to kind of stay away from. Yeah. And usually with hotels, it's the new inventory that's the killer.
Yeah.
Because with the new inventory, you may have a Hilton branded hotel, and then the new guy coming in is building a dual branded Hilton. So it'll be Home 2 and Hampton, and you may have, a different Hilton brand, so, and they're all going to work that same res system. So the brands are getting fewer and fewer.
Right.
Marriott bought Starwood. So now most brands are owned by, the concentration, and that has to be like maybe 2 or 3 companies own all the brands, or most of the brands.
When you have buyers, it sounds like to me from what you're saying, depending on the type of asset that you buy, it can potentially be sort of almost like a coupon, right? Am I wrong about that, or is it?
Yeah, for periods of time, and then you hit a COVID or you hit a financial crisis, and then you're back to the point where hotels are rented pretty much day to day.
Yeah.
So it's a coupon until it's not, and then it's tough, and then it bounces back again. So you've got to get a higher yield to compensate you for that. I mean, I imagine apartment buildings probably more stable, although people can stop paying rent.
Sure. But meaning from the actual how much time and energy an individual puts in. Obviously, our mutual friend puts a lot of energy and time into it.
Right.
But somebody who's buying, Holiday Express or whatever, and is this something like an out of town person could buy and do reasonably well at, or is it?
Yeah, and that it's very much of a cookie cutter concept at that point.
Yeah.
You are a known brand. It's like if you had a franchise restaurant or something. That's a little harder because you've got all these little transactions every day with a restaurant, but it's the same idea. Or like a Starbucks, you're going to put a Starbucks in a market, and it's going to do well, and it's a cookie cutter operation, until things go, until you hit a downturn, and then you're going to have to, buckle down and see through it. But for the most part, it is somewhat of a coupon clipping operation.
So let's just put in an example. Somebody comes in, say it's me. All right. It's me. I'm coming in and I say, Steve, I'm looking to diversify a little bit. I'm looking for a little bit of better yield. I don't know much about the hotel business, but, give me some parameters. What are we going to look at? What types of things are good for a buyer like me in that situation? Like how big, how big should it be? What are the other considerations?
I would probably buy a newer select service deal, a Hampton Inn, a Home 2, something like that. I would probably go to what I would call a second tier market, not a first tier market, because then your cap rate's going to be too low, and it's going to be hard to make a buck there. I would stay out of a third tier market where either the demand's not great or there's just absolutely no barrier to entry. So find kind of what I would call like a second tier market, and then try to just pick it right where you don't have you don't have a lot of new inventory coming in. And then I think in that little pocket of time, you can do quite well. Maybe it's a 10-year period or something. You can do quite well. Maybe you could buy at a 7 or 7.5 cap. Maybe self-manage, get a strong enough general manager where you don't have, or manage, get a third-party management company if you have to. Mm-hmm. And you should be able to get a, double-digit, cash on cash return. You should, you should do better than apartments. I mean, because you're taking on, a little bit more risk. In
California, in these secondary markets, what is the usual? First of all, there's probably some parameters you have, like don't buy, small, building or business that has less than so many rooms.
Exactly. Yes.
Yeah. What would you say that? What's your number on that?
I would say you wouldn't want to be probably under 100. You'd probably want to be around 120, 125, maybe 150. That's kind of where that select service box is. You go under 100, and then the margins just aren't there. It's much harder. You got to hire the same people, and you just have less rooms to amortize it over.
Yeah, that makes sense.
So you get too big. Yeah. Now you just have too many rooms for what the niche of that hotel is in that particular market. And then stay away from full service or anything that has like a heavy food and beverage component. I mean, for example, you have a Hampton Inn and you have a Hilton Garden Inn, and they're basically they're obviously Hilton brands, and they're basically the same room, but the Hilton Garden Inn has this big food and beverage concept to it. So you have all these other employees involved.
Yeah.
And what you really want to do is just sell rooms. So every Hilton Garden Inn owner generally wants to be a Hampton Inn. But when the two brands came out, Hilton Garden Inn, because of its food and beverage, was going to be a premium over a Hampton. And it didn't really work out that way.
Right.
So stick to basically a rooms only operation. And most of the select service brands now are really, really good about that. They'll give you a little food and beverage component, but it's really, really minimal. If you ever go into a Hyatt Place, you actually see they have a curved counter. So you come in and you'll be at the checking in, and then you want to go get something at the bar. Well, the same guy that checked you in will just walk around the counter, and he'll be serving you the espresso or the drink or the food item that has, he just put in a heater to prepare. It's like a microwave.
Yeah, interesting. So, so now we're talking about 100, 150 rooms in secondary markets in California. What is that going to cost you typically?
Probably around number, maybe 20 million.
20 million.
Maybe low end of 15 and the high of say 25, say 15 to 25 million.
Mm-hmm. Okay. So now 15 to 20 million. And what is the typical financing? Is it we're talking about mostly SBA loans for this type of thing?
Yeah. I mean, if you do an SBA loan and you do all the green energy deals, the solar panels and all that, I mean, you can really get in for as low as 15% down. I mean, I'm not sure I recommend that. I think generally speaking with the SBA, it's probably 25%. Conventional loan is probably more like 35%. The SBA has, more restrictions on prepay. I think the prepay, it's like a 10-year sliding scale prepay. So it's very onerous for probably the first 5 years to pay it off, whereas a conventional, you're not going to have that big of a prepay penalty probably.
How difficult is it to get that kind of debt from the SBA on an asset of that size?
I don't really. If you work with the right CDC and you find a good mortgage broker that's got good relationships, has done a lot of these deals, it's not really hard at all. I mean, I sold a deal in Bakersfield last year in the middle of COVID, and they got a high leverage SBA loan. I was really surprised. So if they can get it done then, they can certainly get it done now.
Yeah. And when you have buyers and, say they got to bring, you're saying maybe 25% is about the amount that you would feel comfortable. Maybe it's good leverage, but it's not, 15%,
Sure.
right?
Mm-hmm.
So now we're talking about, a few $1,000,000 down. Can you do SBAs is it typically just an individual, or can you also do it as an equity group?
It's an individual's loan. That's a good point. It's a personal loan to an individual, and there's limits to how much debt you can have. It's a good point. I'm not sure how they do that, because I know they have partners in there, but someone has to personally sign to the loan.
Right.
So it's a little different in that respect.
Yeah, and it's not uncommon. I mean, even, certainly in the self-storage space, for example, where there's a lot less non-recourse debt. I mean, with apartments, it's easy. Fannie Freddie non-recourse debt. You have somebody sign, but it's really a bad boy clause, just basically putting you and saying that, you're on the hook if you do something illegal or nefarious. Sure. But with, self-storage and stuff, typically that's the way we've done it. Is you have one person or a couple people who are guaranteeing the debt, and then, the equity group comes in behind it. I just didn't know from, with the way the SBA works and with the government and all that, if that's kind of how, if that was still kosher or not.
Yeah, I think they are personally guaranteed, at least the SBA portion of the loan, because you have a conventional first. I apologize. I don't handle the loans directly. I'm familiar with it, but I don't know all the specifics. But there's a conventional first, low leverage first, which is easy to get because that's very well protected. And then the SBA makes that riskier piece. And that's, I think, what is personally guaranteed.
I'm going to ask you another question that you may not know, but I always, these are the types of things I'm typically looking at as an investor. But so, in these apartment buildings, we typically, we get a ton of depreciation, right? And part of it is because with apartments, you can take, a significant portion, typically 30% of the acquisition price, during the cost segregation analysis ends up being personal property as opposed to real property. And with bonus depreciation, we're taking that all up front. So in many cases, or in some cases, we're literally, we've got as much depreciation as we've got equity. And it's passing all through, almost like, writing off all your investments. I know hotels are not going to be that good. I don't think anything else is, but I'm curious if when you do a cost seg on a hotel, how it looks typically compared to what I just described with apartments.
Yeah, I can't speak obviously compared to apartments, but I mean, there are kind of general rules with the IRS with how they'll allow you to break it out on the purchase price allocation. What I have heard with clients is that you get accelerated depreciation for renovation. So the great thing about hotels is not great, but you are constantly putting money back in.
Yeah.
Much more wear and tear than you would say on an apartment building or an office building. And I do think that you get to expense a lot of that.
Sure.
I know for my personal hotel investments, we've had great years, and because we've renovated for the next 3 years, my tax hit is very low, even though I know the underlying numbers are really strong.
On a yearly basis, does the depreciation, is it for the most part, and the interest on the debt, has it pretty much offset your cash flow?
To a large extent, yeah.
Yeah. So it's pretty minimal.
To a large extent. But the offset of that is you are putting money into the deal. You are renovating, but you're taking that out of cash flow, and if you've underwritten the deal correctly, you have this, say, 4% reserve that you underwrite all the time.
Right.
And that's already baked into your cap rate that when you bought the deal.
So right now you were saying it still might not be the best time, not a lot of deals trading. Is that right?
Yeah. California, and you probably see this with apartments, it's California is always hard on a cash flow basis to make deals work. I think where you've had success in California is on appreciation. Yeah. But cash flow is always tough. It's really tough now because, like I said, it's hard to force people to sell. Nobody ever if they don't want to sell, it's really hard to make them sell. And especially when they see their numbers coming back so quick. And now even with Delta's starting to recede. So people think, well, our recovery just got pushed back 6 months. We'll be out of this thing. And, 80% of California is now vaccinated, so, I got to believe we're coming out of this maybe in that V that we always talked about.
Yeah.
Yeah. What I do remember talking about before was I suggested just buying hotel stock.
Oh, by the way, let me just say, that I don't know how many people emailed me and said, that recommendation Steve had made me a lot of money. Can you please thank him? I don't know. I had at least 3 or 4 emails, people who went and, you had some REITs that you recommended that apparently just really, hit it big. So.
Well, the funny thing is at that point, I was a little more bullish that we were going to bounce out of this quicker than we did. Actually, COVID had a much greater impact than I thought it was going to have. I thought if it's only impacting a certain percentage of the population, everyone else will go about their business. But I underestimated that. But it didn't matter. There was a nice pop in the market, justified or not, where we bottomed out. And I thought that discount's just too great because these companies that I recommended had phenomenal hotels and phenomenal markets. But a lot of those markets like San Francisco really got slammed, and they stayed slammed. So if I knew that then what I know now, I probably would have been a little more cautious, but it worked out really well.
Yeah.
And interestingly enough, I was reading Wall Street Journal today, and they're saying, hotel stocks are the great deals. These are what you ought to invest in. And it said they're now 10% off their peak from pre-COVID. And I thought, my God, 10% is nothing. Now they're calling that a great deal. And I'm thinking, boy, I wouldn't invest in something that's pre-pandemic, only 10% off.
Right.
That's crazy. But they're saying that's a great deal. So again, you have to be a contrarian. At the time when I recommended it, everyone's like, "Oh, hotels are horrible. Don't invest in a hotel." I mean, well, that's crazy. And now they're saying hotels are hot, and I'm going, well, I wouldn't do that deal now at a 10% discount. That's crazy. Yeah. You should get it much, much bigger. And when you think about it, you're just talking about the equity, which is just part of the capital stack. So the value per room is probably only down maybe 5% pre-pandemic. That's no bargain.
Yeah.
So if that's true, I don't think hotel stocks now are a bargain at all. Now I would probably steer clear,
Yeah. So I was going to ask you if that's, you think probably not a good idea now.
Yeah, I haven't really looked into it. I just assumed that there was a moment in time and we hit it, and now it's probably, it's probably gone.
Yeah.
So I didn't really look into it. And then I saw the article, and the 10% discount is you're not being reimbursed, or you're not being compensated for the kind of risk I think you're taking.
Yeah. Especially given.
And I think we've seen how stupid policy can get. Yeah. And really, now it went from stop the spread to let's have zero infection or something. And they can really shut you down. I mean, it's crazy,
Yeah. Well, it is what it is, like I think many people, in the contrarian world, we kind of are, had expected there to be more stuff in discount, but there really wasn't, right? I mean, it was
well, it's like I said, when everything is underwater, how does the lender foreclose? Because then the lender is underwater, and the regulators from the get-go on this were saying, we're going to go easy. We're not going to force the lender's hands to make this happen. And so I figured nothing's going to happen. And I did think this would be somewhat of a V or a U or something, and it would come out of it pretty quickly. It wasn't like a normal financial recession, which could go on for 4 years. And then even if the lenders want to look the other way, they can't at some point.
Yeah, absolutely.
But here I figured we'd get out of it quick enough that they would be able to. And I think that's what's happened.
What do you think in terms of long-term, hotels? You're still bullish. You still think it's a good place to be, obviously. Tell us the case for hotels in the next decade.
Yeah, I think hotels, again, I think long-term you get rewarded for the risk that you take, because it's an operating business, and in good times they do very well. You just have to probably have a bigger financial cushion than you thought you needed because things happen. COVID happens, the next COVID will happen, and you just have to have, you gotta be able to withstand that 12 or 18 month, period, but otherwise I think it's good. Be wary of, low barrier to entry markets. Luckily in California's pretty tough to build in, generally speaking, although some markets you can slap things up pretty quick. The cities are, real bullish. So you have to be careful of new inventory, but those are few markets. Most markets are pretty high barrier to entry. And I would also look out for what did COVID do long-term to like CBDs, like downtown LA or certain markets. Are those going to come back, or are you going to have now remote work? That's something, what's happened that's going to stick with us? What was kind of already happening and COVID just accelerated the trend.
Yeah.
CBDs.
What is CBD?
Central Business District.
Okay. Central Business.
How many people are going to now want to go back and commute an hour to get downtown when they got comfortable in their living room? So those
probably
are trends.
Less people flying in, to meetings, right? Because they're all doing Zoom now.
Yeah. So I'd be wary of heavy convention markets. This exposed some things. Markets like Anaheim with Disneyland, where you have that one big demand generator, and something like this hits. Just be wary of that, because I think it exposed how vulnerable some of those areas are that we never. Disney's bulletproof.
Yeah.
Disneyland's bulletproof. It's great. It is, but you've got to build in these cushions for the moments like this.
Yeah. Good stuff, Steve. It's always good talking to you. What if somebody wants to get a hold of you? Website?
Titan Hospitality1 at Gmail.
Fantastic.
That's the email.
And is there a website associated with that?
Yeah, titan-hospitality.com.
Perfect. Steve, Usher, thank you again, my friend, and hopefully we'll have you on another 6 months or so and see how this hotel thing is working out. It's something I definitely am interested in focusing on potentially in the future myself.
Great. It's never a dull moment.
See you right back. Welcome back to the show, everyone. Hope you enjoyed it. I think Steve is a great guy, and he's smart. I think it's really cool that he comes on here and he's like, yeah, it's, last time he's like, there's nothing to buy, invest in these REITs, and then people make a bunch of money. He's just like one of the guys you want to, if you're interested in this space, he's a good guy to talk to, because brokers notoriously are bad about just selling you on things that they don't believe in and stuff. But Steve's definitely not one of those guys. So if you're interested in hotels and you live in California in particular, make sure to reach out to him. But otherwise, pretty cool stuff just to catch up on. I do want to remind you before we go, a couple things. First, we have had a bunch of new members on Wealth Formula Network, and it's really just a really great opportunity, again, to get into a rhythm of, drilling down on personal finance with a group of people who is interested as well. So check out that whole thing. The course and the group and everything all comes in one, wealthformularoadmap.com. And the last thing I want to mention, and I don't mention it very often, but I need a favor from you. If you have not done so, go to wealthformula.com. There's a little button there that basically guides you on how to do a review on iTunes. Maybe you already know how to do it, so you don't need to do the leave us a review thing. But if you get a lot out of the show, if you think that, we're doing a good job, make sure to go ahead and give us 5 stars and write a comment. I had some really good comments, and I should read them sometime. One of them said something like, it's the only podcast that makes me money. That makes me feel good. That's what we're trying to do. That's what we're trying to do, is trying to help people get ahead in this financial world. But go to check that out if you can. Leave us a 5-star review. That's it for me on this week's episode of Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.